Welcome to Conversations, Season 2 of the MTA Podcast Series, a weekly audiocast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association.
Well, good afternoon. It's Tuesday, March 15th, 2011. Welcome to Conversations, the official MTA podcast. I am Tim Braun, CMT with RBC Wealth Management, and my two guests today are Kevin Hockert, CMT with Prospero, and our guest speaker, Tom McClellan of the McClellan Oscillator and publications. And with that, I'd like to introduce, or have Kevin introduce our guest speaker today, Tom McClellan. Kevin?
Yes, thank you, Tim. Tom McClellan is the editor of the Daily Edition and the McClellan Market Report, and he's been at this since 1993. Tom has a background in aerospace engineering. He was a helicopter pilot for 11 years with the U.S. Army, and he conducts a ton of analytics with respect to a variety of financial markets. He is the editor of, as I mentioned, the McClellan Market Report and the Daily Edition, and he is the son of Sherman and Marion McClellan, who are the inventors of the McClellan Oscillator and the Summation Index. Tom's work has earned him high ranks in the past from Timer Digest for a variety of his market calls, and we are delighted to have him as our special guest here today.
That's great to be with you guys.
Thank you, Tom. Tom, maybe you can give us kind of an overview of the current status of the market, and then just in our meeting today, you talked a little bit about some of the cycles. Maybe give us a brief overview of some of the cycles that you're seeing, and then maybe follow up. Maybe we can follow up with a couple of questions, and then maybe the fitment of the your parents' work with the McClellan Oscillator to kind of give us a handle of Tom McClellan's view of the world as it stands today.
The most important factor affecting the market right now, aside from the Fed throwing money at it, is that we're in the third year of a presidential term, and we're also in the fat part of the third year, meaning we're in the strong seasonal period that lasts from about November to June, and it's especially effective in the third year of a presidential term, and we're in the middle of that right now. The market should be going up, and it is going up. That doesn't go up in a perfectly straight line. It has some texture to it, and that texture is being amplified by world events as we have the weeks now after the Japan earthquake and tsunami to deal with. So in the midst of that strong upward trend, there are normal cycles that come along. We had a 164 trading day cycle that was due to bottom sometime in late February to early March, and my belief is that the Japan earthquake is kind of bending the amplitude of that cycle bottom a little bit more than it would have otherwise been bent under normal conditions absent that factor. But it's not the end of the world. It's just a bump along the way, and we should be headed higher from now until June.
Tom, when you say we're headed higher, today there was rather a abrupt sell-off because of some of the worldwide events that were taking place in Japan. When you talk about it going higher, can you give us a feel for what you mean by going higher?
I wish I could give you a price number, because on CNBC they think that all the technical analysis comes down to technical levels. We all know much better than that there's much more complicated than that. But in a general uptrend between now and June, we have three big things going for us. We have the strong presidential cycle that tops out in early summer, the normal seasonal pattern that happens every year, not just the third year of a presidential term, but every year we have a seasonal period of strength up until about June. We have the Fed conducting permanent open market operations where they go in with cash, money, and they buy bonds, treasury bonds from banks. Those bonds, the banks give up, then go on the Fed's balance sheet, and the banks then have cash that they need to figure out something to do with. A lot of them have been putting it into the stock market, and that's due to continue until June, when the current round of quantitative easing is set to end. And so you have seasonality running out in June, you have QE2 running out in June, and you have the summer unseasonal period and some other leading indications that we look at that say the period from June to October is going to be an ugly period for the stock market.
All right. Hey, Tom, I appreciate your insight and the amount of work that you've done with the presidential election cycle and POMO, the commitment of traders, $0 future contracts, all of it very insightful, and yet at the same time, as you had mentioned, it kind of falls under the general camp of helping describe what the market should do. At the same time, I've spent a fair amount of time working with your McClellan Oscillators and Summation Index, obviously nowhere near the amount of time that you folks have. I found it interesting that the NASDAQ Summation Index kind of started to issue a little bit of a warning, perhaps, maybe 3-4 weeks ago. Yet the NYSE has remained pretty strong. I guess I'm giving you an opportunity here just to maybe comment on the NASDAQ summation tailing off a little bit, what that means in terms of investors' appetite for risk. And then also here, just perhaps today, some pretty low levels in the oscillator values, and maybe that can tell us something. Maybe that's occurring timely from the standpoint of what you were expecting from your 164-day low, which is due tomorrow, perhaps.
Well, I never talk about it being due on a precise day because cycles tend to be only approximate. If you're firing a rifle shot from 164 days ago, you're only going to hit close to the target. We tend to turn to other shorter-term tools to home in on the exact short-term bottom. The McClellan Oscillator day is well below -200, which is a very deeply extended reading, very oversold reading. Being oversold doesn't mean you're done getting oversold necessarily, but it does suggest that the bungee cords have been stretched and you're ready to snap back as soon as events will allow it. I do believe that the Japan earthquake and the response to that has changed the amplitude of that movement. Just as the big sell-off that we had after the 9/11 attacks changed the amplitude of what was due to happen then already anyway. We were expecting a bottom September 21st of 2001, and it came in right on schedule. It just got stretched to a much greater degree than it would have otherwise. So I sense that the same thing is happening now, and that once everybody's nerves calm down a little bit and they realize that there's a whole mountain of cash waiting to get put to work, that they'll start using it to push stock prices up again.
Okay, thank you. Let me ask you another question if I can. The extent of your analysis gets pretty detailed, and needless to say, you're able to take the complex and make it simple, and sometimes some of us can take what's simple and make it complex, and is that always a good thing? I guess my question is, if you were to look at the S&P or any of your favorite markets and just really kind of boil them down into simple terms. The S&P, for example, intermediate term uptrend, a little bit of a correction. Would you care to describe the market in terms of some support levels? Maybe an upside. Understanding that we're not really trying to pinpoint or box you into certain price points, but anything you care to share with us in terms of just traditional bare bones TA on some of the more popular financial markets?
Well, one of the things you mentioned before is that a lot of what I look at refers to what the market should do. When you talk about cycles, when you talk about leading indications, you're talking about what should happen. And I like working with the should indicators, but you also have to work with the is indicators. And you have to verify that what should happen is happening, and if it's not, then you got to decide what to do. Right now, we should be in an uptrend. We're supposed to be in an uptrend according to all the different leading indications that I look at. And except for just the last couple of weeks, we are in a nice, strong uptrend. We're just having a normal cyclical correction that's coming along when it's supposed to. And we should get back to proceeding on that uptrend. When you have the advanced decline line continuing to make new all-time highs, which even the S&P hasn't done yet, that condition can only occur in a very liquid market, when there's enough money around that even the least deserving stocks can get some of it and they can go up. That's what having a very strong advanced decline line tells you, and that's what the indication is from the McClellan Summation Index and McClellan Oscillator that look at the acceleration of the advanced supply line. They're saying it's a very liquid market right now. At the point when liquidity changes, those indicators will help us identify that. I'm expecting that liquidity is going to change dramatically after June, when the Fed ends its quantitative easing and when the calendar changes from the favorable seasonal pattern to the unfavorable period. I'm expecting that liquidity is going to change, but I'll be watching the confirming indicators to see what is actually happening with liquidity.
Thank you.
John, question for you. This is Tim Braun again. The question that I have is there anything that could or would change your mind with the the market should be doing this? Obviously, you have an entree to what it is doing, but what would it take then to kind of change the outlook that you just kind of, is there anything there that would change your outlook?
Well, Bernanke could have a heart attack. That would change things dramatically, because then nobody would know what the Fed policy was going to be. Not even the remaining board members. They would have to all decide what the Fed policy was going to be, and that would be an event risk that would be bigger than Reagan getting shot or Kennedy getting shot or Eisenhower having a heart attack. If the Fed chairman ever had a heart attack, that would really rock the markets in ways that none of the forecasting tools I use can model. So that's the event risk that I really worry about.
Okay.
Even if we had a radioactive cloud coming across the Pacific, that would have a dramatic effect on a lot of people's lives, but not greatly affect the financial markets. When 3 Mile Island let loose a little bit of radiation, barely detectable amounts, that didn't really affect the markets. When the Russian nuclear plant at Chernobyl had a meltdown, that was a momentary effect in the news and a dramatic sustained effect on a lot of people's lives in that area, but it didn't really change the valuation or the movements of the stock market. It didn't change the liquidity picture. Things that would change the liquidity picture is people suddenly deciding to hoard money for whatever reason, and when the Fed is pumping money out faster than banks can know what to do with it, that's not a condition that it tends to stimulate hoarding.
So short of a heart attack by Bernanke, you're pretty comfortable with your outlook.
Yeah, I'm comfortable, and I'm still watching it. I trust and verify, and so when you see things happen, and when you see what's supposed to be an uptrend, and it is an uptrend, and you see a huge oversold opportunity on a short-term basis develop, those are great opportunities.
Thanks, Tom. Hey, I think maybe we have time for one more question before Tim signs off here. Kevin Hockert again. A lot of our listeners are probably pretty curious as to what your position might be on the commodity markets. A couple of weeks ago, seemingly they seem to be telling us that it's off to the races again. And within the last week, perhaps it's starting to look like a different picture. You had shared with us a little bit about gold and how it tends to be a leading indication for the commodity market in general. I found that to be quite interesting. Do you mind sharing your views and perspective on that again?
Sure. The basic idea is that gold prices tend to lead commodities prices by just short of 4 months. It's about 75 trading days.
Okay.
So you can take a plot of gold prices, and you see that the new CRB index, or the old version called the CCI, shift forward in the chart the plot of gold prices by 75 trading days, and you'll see the bottoms and tops line up. What that's telling you is that the same dance steps that gold just went through are what commodities prices are going to be going through with that 75-day lag time. So commodities prices just recently reached a peak and sold off a little bit, right on schedule with the top that gold prices were having late last year in December. Gold has, we're recording this now March 15th, gold has been basically chopping sideways violently at a high level, which says that commodities prices should also chop violently sideways at a high level. You'll see commodities prices go down in a more permanent way once you see gold prices go down, if indeed we ever do see that. And what it takes to get gold prices to go down is for the Fed to raise interest rates higher than the inflation rate. They haven't shown any willingness to do that, so the long-term fundamental factors affecting gold are really bullish. As long as the Fed is going to continue to have negative real interest rates, that's bullish for gold. and then 4 months later it's bullish for commodities. Oil prices are a big part of that right now, but they correlate very well with food prices and metals prices that are part of the whole commodities complex. The different commodities correlate much better with each other now than they used to years ago. There shouldn't really necessarily be any kind of relationship between cotton and copper, other than phonetically. But now that we have so much money, where you have commodity index hedge funds running money, the health or the lack of health of the whole commodities complex tends to be much more unified in sync based on the money flows into and out of those commodity index funds. So you see much more automatic correlation among them than was the case many years ago.
Okay. Yeah, understood.
Very good. Tom, we're kind of edging in here on our time limit, but why don't you give us an idea if any of our listeners want to find you or your publication, where they can do so?
Oh, if you just Google McClellan Oscillator, you'll find us. In fact, our website is MC Oscillator, so it's like a McNugget, except it's a McOscillator. McOscillator.com. You can learn a lot about the McClellan Oscillator and the other tools that we use. You can also sign up for our free weekly chart and focus email. You just need to name an email address, and you'll get that sent to you. No strings attached, and we won't share your information with anybody. It's just a free weekly technical analysis lesson about one chart at a time, a different chart every week, and it's awfully fun. You can also look through the archive of the past articles there.
And that's all at mcoscillator.com.
Correct. 2 L's in oscillator.
Very good. That wraps up today's MTA podcast. My guest today was Tom McClellan of the McClellan Market Report. This is Tim Braun and Kevin Hockert signing off, and we'll podcast with you again soon. Thank you very much.
Thank you, Tom.
All right. Thanks, guys.